Hello everyone, this video is to provide a quick overview of transfer taxes and wealth planning. The unified transfer tax system is an integrated tax system including the gift tax as well as the state tax. The gift tax reporting is done on Form 709 and the state tax reporting is done on Form 706. Although this form is year specific, the gift tax and the state tax, they do have a cumulative feature, which is very different from the income tax. Consider the income tax we have talked about last semester and this semester on the individual taxation as well as the business taxation. The income tax is based on a taxable income. It's more income driven taxation. The transfer tax is very different from income tax in a sense. The trigger event is a transfer, the property transfer. So in the gift tax scenario, there's a transfer of property from a donor to donee. And from a state tax perspective, there's a transfer of property from the descendant to the heir. Um, so in both cases, there is a property transfer event. And generally speaking, the donor and the descendant or the transferor is responsible for the tax triggered. Okay, what is unified transfer tax scheme? Since 1976, what are the common features? First of all, they functioning under the same progressive tax rate schedule. So I'm going to take a quick look at this unified transfer tax rate schedule, which is this is a progressive tax rate schedule. This is very similar to the individual income tax schedule you have seen in the past. However, this unified transfer tax rate schedule works for the gift tax as well as the state tax. And as far as the exclusion or the exemption amount, it's the same exemption equivalent from year to year. And this gift and the state tax exclusion is combined. Okay, so now let's take a look at some other feature. One of the thing is the cumulative transfer, including gift and the state. So we're looking at the cumulative transfer, the lifetime transfer, as well as the transfer at the death of the taxpayer. The other thing is applicable credit. This is a unique concept, applicable credit at the current rates based on the exclusion amount. So there's a lot of new term here. Again, this exemption equivalent is also tracked year by year. It's on a cumulative basis. And further, there's unlimited charitable deduction and a marital deduction for transfers to a spouse. And generally speaking, the transfer of property is valued at the fair market value of the property at the time of the transfer. Now let's take a look at the gift tax. What transfers are subject to gift tax? Generally speaking, it covers the lifetime transfer of a property for less than adequate consideration. And again, the other thing is we want to make sure the transfer is complete. So the gift is complete when the donor relinquishes control over the property and the donee accepts the gift. So both parties have to take actions. And the tax base for the gift tax, generally speaking, is the fair market value of the donated property and minus any annual exclusion. So for any present interest type of gift, the annual exclusion apply, and for future interest, the annual exclusion does not apply. So from legal perspective, we have to distinguish what is present interest and what is future interest. And there are also some special rules regarding the property with joint owners for you to read. Again, to figure out the gift tax base could be very complicated depending on on the transaction. Who is subject to the gift tax reporting? Again, the donor will be subject to the reporting. The donor could be a U.S. citizen or residents or non-residents, non-citizens of the United States. Again, this definition of non-residents, non-citizen of the United States is different from the non-residents for income tax purposes. This is something just to be noted. And for the non-residents, not U.S. citizens of the United States, the transfer of gifts of tangible property situated in the U.S. will be subject to the gift tax reporting. The other thing is if the donor is a beneficiary of trust, state, partners, or partnership, and the stockholder of the corporation, they can also be subject to gift tax reporting. And in a special cases, in a special case, donor's executor, if the donor dies before filing the return. So there could be a lots different types of filers. But generally speaking, is the donors, wherever the donor, the transferor, will be subject to the gift tax reporting. Okay, for estate tax, the transfer subject estate tax normally is, there's two type. One is the gross estate is covered as the probate estate, so property possessed or owned by a descendant at time of death, and the property automatically transferred at the time of death. The property transferred within 3 years of a death, and the gift tax paid on the transfer within the 3 year of death. So basically, the gross estate covers three type of the property. So it's not only the property transferred at the time of death. So there's a quite a bit information collection, to calculate the starting point of the state tax calculation, the gross estate. The valuation is either fair market value or the alternative valuation date if the executor elects alternative valuation. So as you can see here, there's a lot of legal terms involved in the state tax calculation. Therefore, the gift tax, state tax, normally it's a niche, special areas for practice. A lot of times it's very much linked to the state tax planning. Okay, who is subject to the state tax reporting? Generally speaking, the executor, the personal representative, or administrator of the descendant's estate will be responsible for the state tax reporting. These descendants could be a U.S. citizens or U.S. residents at the time of death, or can be a non-resident, not a citizen of the United States, but they do have some state situated in the U.S. So in that case, the executor of the state will be responsible for the state tax reporting. There are some additional topics regarding the transfer tax. The generation escaping tax, the GST, applies to the gift tax as well as the state tax. Again, these are supplemental to the gift tax and the state tax, and it normally is triggered by transfer of property to someone more than one generation younger than the donor or descendant. So this is something it's in addition to the gift tax and the state tax. When there's a transfer of property to someone more than one generation younger than the donor or the descendant. So the tax basis of the property from the transferee, generally speaking, for the gifted property is a carryover basis, and for inherited property, generally speaking, is the fair market value, either step up or step down the descendant's basis. And the gifted property, actually, the basis of the property, tax basis of property for the transferee could be a little bit more complicated than this, depending on it's a lost property or gain property. When you read the textbook, you can read a little bit more on this. For the role of the fiduciary entity, it is a legal entity that takes possession of the property for the benefits of person. So in this case, it could be either a state or a trust. So this is something it's not discussed in detail in this chapter because we're really just focusing on the transfer tax calculation. So again, the key for our exercise homework is all about computation of gift tax and state tax and understand the form 706 and 709 at a high level. And the marital charitable deduction, applicable credit, deceased spousal unused exclusion, a unified transfer tax scheme, all that stuff. So, we're going to use the Excel workbook to take a quick look, see how the gift tax and state tax are calculated at a high level. Finally, the state tax planning is a big part of the wealth tax planning. And the ultimate goal of the wealth tax planning is to maximize the after tax wealth to be transferred from an older generation to a younger generation. Therefore, it is a big deal. So, all the planning strategy we have talked about in other chapters still apply. What's the timing? What's the timing of the transfer? When to transfer? Who pays transfer tax? When to shift to the income? When to shift to transfer the property? And the conversion and the common vehicles for transfer tax planning. Also, this is something gets a little bit more on the state planning side. So this is just something for your information. For homework, the key here is just for us to have a high level understanding how the gift tax planning, gift tax calculation is done. So I have the template kind of laid out, some of the big components here. And of course, it's not an all-inclusive list of the items to derive the form, the gift tax. If you want to take a deeper, a closer look of the Form 709, feel free to do so. You will see a lot of the big items we see here can be linked back to the line items on Form 709. So from a gift tax perspective, the starting point is to collect information for the donee for the donor on all the gift transfer happened during the year, and the annual exclusion is applied at each donee's level. Okay, so this is something we have to figure it out, and there's a lot of stuff happening in between. So we need to check into and see all the different parts. Then we can start with overall total gifts. Then apply the split gifts rules, and also the annual exclusion and the marital deduction, charitable deduction, all that stuff, and to get to the current taxable gifts. Current taxable gifts. Once we have the taxable gifts, then we can move on to the gift tax calculation. Again, there's a lot of steps involved in calculating the gift tax. So once we have a current taxable gifts, then we're going to add on the prior year taxable gifts. Again, this is a reflection of the gift tax is assessed on a cumulative basis. So we're going to look at the prior year taxable gifts. Then we have the total cumulative taxable gifts. Then we're going to calculate the tax rate, tax for the gift tax based on the transfer tax rate table. And then we're going to apply any applicable credit, and then we can reduce the gift tax payable. So basically, any tax at occurrence on the prior year taxable gifts plus any unused applicable credit will reduce the tax payable on the gift tax, and to get to the final gift tax due for the current year. So there's a lot of steps involved. This is kind of mirroring what's happening on the Form 709. And worth noting, there is a quick calculation. It's a shortcut, quick, dirty calculation for the gift tax due. uh, you can see this is it's a much more straightforward rather than we have so many steps here. So basically, what we're saying here, if we have the current year taxable gift, which is taxable gift 35 million, then once we figure out the unused exemption equivalent amount, which is which is basically equal to what we're going to take a look is the current year exemption equivalent minus any exemption equivalent used from prior year to figure out what is unused exemption equivalent. So that means this is whatever the leftover exemption amount which has not been used. Then we get to the taxable transfer in this period. Then we apply the marginal tax rate as 40%. Then you can estimate your gift tax due pretty quickly. As you can see here, this quick and dirty calculation in a lot of instances actually match up with the gift tax calculation step by step based on the Form 709. The reason behind this is at the end of the day, even though the applicable credit is happening in between here, in theory, what's happening here is for a gift tax calculation, what we're trying to do is we're trying to make sure that the prior year gift is not double taxed in current year taxes. Consider the current year exemption. And when you think about the credit applicable uh, applicable credit, this is something is done on a progressive tax rate basis. That means as long as the taxable gift is more than a million, so the incremental effect of the additional tax on the gift, anything more than a million normally is taxed at a 40%. So that's why this quick and dirty calculation actually a lot of times will help you quickly get to the gift tax due, rather than for you to go step by step to figure out all the in between steps to figure out the final answer. That's why I think this is really helpful for you if you are try to calculate the gift tax due. The state tax is similar in a similar concept here. This is also a high level illustration mirroring the Form 706, and to kind of show you what's the starting point of the state tax calculation. It start with the gross state, and then adjust by liability to get to the adjusted gross state. Then we layer on the marital deduction, charitable deductions, and we start with the state tax base. The state tax base is start with the taxable state plus all the taxable gifts from prior year, and again, this is a cumulative taxable transfer. And next, we're going to take a look at the tax on the cumulative transfer. Then we're also going to deduct any prior year gifts, which is already paid, tax already paid, as a current rate. So basically, we're taking this piece out to ensure there's no double taxation on the prior year gift, because our starting point is the cumulative taxable transfer for the state as well as for the prior year gift as well as the state. Once we have the tentative tax, then we apply the applicable credit for the current year to get to the gross state tax. There's also a quick and dirty calculation down below. You will see this is a slightly different calculation, but did come up with the same answer as the gross state tax by doing this detailed calculation here. What that means is this quick and dirty calculation kind of highlights, what is the core, what is the gist of the state tax calculation. Really, what's happening here is we're starting with the current year taxable transfer, which is the state tax, the gross state, and then we plus any prior year taxable transfer, which very likely is a gift transfer. Then we minus any taxable transfer from prior year after consider the exemption, consider the exemption. Then we minus the exemption allowed in current year to get to the estate tax base. So again, at the end of the day, if the state tax is large enough, generally speaking, the marginal tax rate, the 40%, will kick in, and to get to the estimated state tax due here. So again, the core of this chapter is on the gift tax and the state tax calculation. Of course, from a legal perspective, there's lots of rules regarding what's going into the state, what's going into the gift tax base. Again, those are for your reading, for your information only. And for us, we just want to focus on the steps of how to calculate the state tax and the state tax and the gift tax. So the homework 2045, this is regarding a gift tax calculation, and homework 58 is state tax calculation. For homework 45, I already kind of outlined the calculation for you. However, please make sure you write down the explanations and make sure you understand how the calculation is carried, why it's carried this particular manner. Okay, with that, I'm going to conclude this session and thank you for listening, and you have a great day.